Let's start with your investment approach. What is your selection process based on?
Well, we principally want to make money like everybody else, that's clear. We believe very strongly in equity. The problem is from time to time you have sideways markets. We are in such a sideways market. I'm speaking of several years. And for that purpose, I want to get some kind of safety, and that's why we use long-short funds. Long-short funds have the advantage when markets go down, they also go down, but not that much like long-only markets. And so we try to select about 10 to 12 in a fund. In a fund, we try to select about 10 to 12 target fund. This helps to reduce the risk, and it's lower volatility, and over a business cycle or a market cycle, we still can beat the long-only indices. So the purpose is to beat long-only indices. In principle, we fight against ETFs. It's not so easy, but we have succeeded so far.
Equity markets are an attractive asset class, being particularly liquid and transparent. What would your advice be to the novice investor?
Well, what is a novice investor? Is it 15 years old? Is it 40 years old? I think, never mind which one, long term, it's attractive. Equity proved in the past it's attractive. But once more, we have cycles. Warren Buffett, he speaks of 16-year cycles. I think it's 18-year. I've calculated that way, but the problem is sometimes they are 15 years, sometimes then 22 years, and 7 years in between you can be wrong, so that's not so easy. Right now, we are in a sideways market. The positive markets would be the buy and hold market. We are definitely not in a buy and hold market, but equity long-term definitely is the best investment.
It's been said that the future lies in emerging markets. What's your view on that?
Oh, definitely agree. Myself, I have 70% of my money, my family's money, in emerging market. Asia, where I prefer China, Southeast Asia as well, and some East European countries as well. I'm not so hot for Latin America. However, I know they've done a good performance over the last years. GDP growth in emerging market over the last dozens of years has been about 8%, and the developed market about 3%. So it's much easier in an environment where GDP is growing by 8% to find companies which grow, where you can profit. Return on equity is higher in these type of markets, and definitely yes. Disadvantage of emerging markets are more volatile, and you just have to get through. If you go back 20 years and you take Morgan Stanley Emerging Markets Index, you went from 100 to 2,000 over 20 years, so made 2,000 profit. But between 94 and 204, you did nothing. You even had 2 down markets in between. So it's a long-term thinking. It's not the 3 months or 6 month thinking. It's really long-term thinking, but definitely emerging markets.
What benefits do long-short funds have over other long-only funds?
Long-short funds have the advantage if you have a declining market. Long-short funds lose money as well, but much less. So if I may say it in numbers, if you start at 100, you drop to 80, you only have to make 25% back to break even again. If you fall from 100 to 50, then you have to double your money again to see your money initially which you invested. So if you take Morgan Stanley World in Swiss francs over the last 10 years, that one lost 50%. So we have to double it to see the money again, which we have had in 2000.
And as an investor, how important is it to diversify your portfolio?
Oh, diversification is very much important. If I knew on the first day that I select the best fund or the best company, then obviously I should only have that one. Right now we have a Brazilian fund, a Brazilian long-short fund, which did 380% since January 2009. So a bit more in 3 years, he made 380%. Is he going to repeat it? I don't think so. Definitely not. So if I were sure he would do it and would give me all my money, I'm not going to do it. So I think diversification is a need, and you have to have at least 10 to 12 funds.
Finally, how can we protect against extreme risks such as the ones experienced in 2008?
Well, then you try to find out what was functioning in 2008. In 2008, you have had the CTAs, the commodity trading advisors, or you had some called the managed futures. A bad one has done 20% plus, a good one has done 100% and even more. So if you have a down market in stocks and you can combine it with with the CTAs, managed futures, then definitely on the good side. And that's why some people use now that one. Now the studies back from 2008 shows you the efficient frontier would be about 70% what you did before, so long only and long short, and about 30% what we call tail risk products. What are tail risk products? Not so easy to say, but certainly CTAs, managed futures, and gold as well. Gold did plus 4% in 2008, and a new strategy is also the volatility funds. By the way, the volatility funds this year helped us in May to have a better performance. We have one volatility fund which did 22%. So that was very pleasant for the month of May, where markets really did not do well.
Erwin Brunner, thank you.
Thank you.